Hey everyone, welcome to another video on the channel. Today we're going to be taking another look at ZIM Integrated Shipping Services, also known by the ticker symbol ZIM. Before we get started, I'm not a financial advisor, so do your own due diligence before making any investment. But focusing on ZIM here, ZIM just reported their quarterly earnings this past week, and man, did they crush it. And I'm going to go all into detail about that in a second. But first, let's take a look at the chart. So we could see that it looks like, at least in the short term, ZIM may have actually formed a bottom. It's about time, right? In December, January. So since then, we could see that we've clawed our way back around that 2250 level that had been forming a sort of support in October, November. We've been struggling to try to retake it. So far, we've retaken it. Whether or not we could hold, that's going to be another issue. But undoubtedly, the earnings probably helped in getting back up. And let's focus right in on that. So, ZIM crushed earnings. Let's get to the specifics here. So, all right, yikes. So they reported fourth quarter sales declined 37%. Doesn't sound great, to 2.19 billion, but it beat the consensus of 2.11 billion. That's a substantial beat. And again, as we know, the revenue decline is primarily because of the freight rate declines, which we've talked about many times. But here's something. EPS beat. It was $3.44 compared to the consensus of $3.05. That's a 39-cent beat. That's a major beat. So that's positive. Adjusted EBIT margin was 27% compared to 61%. And adjusted EBIT declined 72.3% year over year to $585 million for the quarter. You know, those are tough numbers, but again, it's just what the consensus is. So everyone was expecting that sort of decline. Here's something more positive. ZIM's total cash position improved from $3.81 billion as of December 21 to $4.6 billion as of December 22. And this is really key, I think, because, you know, all these shippers are being crushed. And some of these shippers, I think, are probably going to end up going bankrupt. A lot of them are going to be in horrible positions, and the whole industry is in a horrible position. But I think ZIM should be able to make it through to the other side and become more profitable again, you know, hopefully. But because they're going to make it through because they have all this cash that they're sitting on, that's going to help them through the hard times that we've been in for the past months and that we're in right now, and that may continue into 2023. So that's a great thing to see, that their cash position has improved substantially from December of 21 when, if we recall, back then that's when ZIM was riding high, when shipping rates were insane and still in the post-COVID or the current COVID situation. So they've just been piling up all this cash, which is great. The adjusted EBITDA decreased 58.8%. The margin was 44%, down from 68%. Again, not great to see those margins declining, but expected. And net cash generated from operating activities was nearly cut in half, which is tough to see. 1.07 billion compared to 2 billion a year ago. Almost cut in half, which it's tough. But as we said, hopefully this is at least the bottom or a temporary bottom, and hopefully their cash position now could help them see it through the tough times. Also, their dividend was declared, so they're going to be paying a $6.40 per share dividend on April 3rd to holders of ordinary shares as of March 24th. Now, if you recall, their last dividend, I think, was $2.75, something around there. So they're increasing their dividend, which is a positive sign, which is something that's sure to keep investors who are holding the stock to continue holding the stock. We don't want to see a bunch of people just start dumping the stock because because of all these numbers that are saying because their cash generated is cut in half, because of their EBITDA is decreased. We don't want people to just start throwing the stock away. And one of the ways to prevent that from happening is to offer a nice fat dividend, which is exactly what Zim's strategy has been for a while now, what they've been doing, and now they're continuing to do it. So that's good to see. I want to also focus specifically on some of what was said during the earnings call. If any of you have gotten a chance to, to listen to it, I would recommend it. But, specifically, let's look. So, here the CEO, Eli Glickman, is talking about these numbers that we just kind of discussed. That's fine. But what I want to focus on are two things, really. One is that Zim has this strategy which they've been having for the past year. They've been investing in acquiring these LNG fueled vessels, which I think is going to really help them in the future, as a lot of these companies and a lot of these asset managers are looking for ESG positive related developments, and having a LNG fuel vessels just makes them more enticing to investors that are looking for that ESG rating. And Zim is definitely in the forefront of those carriers that have been really emphasizing the LNG, the ESG positive flows. Now, also, I thought this was something worth pointing out. So, as they've been replacing smaller vessels with larger ones, the cost per TEU will decline. That's another part of their strategy. So, is to get rid of some of these smaller, ineffective or inefficient vessels and replacing them with larger vessels, which is just more profitable. That they could throw more containers onto these bigger ships and only have to sail one ship or fewer ships and sailing a bunch of smaller ships. That's just going to streamline their process. That's going to make them more competitive. And he even says here, this will allow them to competitively operate in low freight rate market and weaker demand environments, and maintaining their objective of maintaining the positive EBIT. So, and it also underscores their ESG target, again, something they've been focused on. 28 of their 46 new build vessels they secured with LNG power, making them an industry leader in terms of low carbon intensity, which, as we said, they're an industry leader. He said it, I'm saying it, in the ESG related world. So that's positive. That's a good sign, at least in terms of also comparing them to a lot of their competitors, which are very inefficient in that regard. Something else I thought that was interesting or worth pointing out is they've been strengthening their presence in other markets such as Australia, New Zealand, Thailand, Vietnam. I think this is a serious positive. I mean, so much of their bread and butter is shipping stuff from China to the west coast of the U.S. And that makes sense, right? Those are like the two biggest kind of places. But as we've seen, the U.S., we've had all these recession fears, so people have been buying less, etc. All the retailers, everyone's been hit by that. Everyone expected the past like Q3 or Q4 of 2022 that we might be helped by the fact that it's like Christmas, holiday season, people would be ordering stuff. We didn't really see that so much. As we saw on the first page, that's basically when they bottomed. They weren't able to capitalize as much. And in China, there's still so much uncertainty with zero COVID and all these geopolitical things that are happening. So the fact that they're able to strengthen their presence in these other places, Australia, New Zealand, Thailand, Vietnam, it's good to diversify their presence and gain a greater presence, especially noticeable is this Thailand and Vietnam, because he even says, I won't go down and find it, but as people are now looking away from China because of all the geopolitics, where are they going to look? They're going to look in Southeast Asia, among other places. So again, just I'm curious to see how that develops in terms of what share, how much market share they're able to get in those areas. But another thing I want to point out is Zim has more than just shipping between, as I said, the West Coast of the U.S. to China. They also have these other companies, these other profit streams, and one of them that they're working on is they're expanding their e-commerce service to the Port of Baltimore, which this fascinates me. And again, I don't know if this isn't something that could replace the China-U.S. trade, but it's just another component of their business that's going to help diversify their business, so it's not as dependent on that East Asia to North America trade, which is so critical. But it's not all sunny skies, as they say. So I thought this would be good to look at a more pessimistic view, just to keep everything sort of balanced, because, as we've said, Zim does still have some challenges ahead of it. So, as this article is pointing out, their 2023 EBITDA guidance is down 73%, which is a scary, it's a big number. But I also wanted to see how he talks about the earnings beat. So they reported net income of $417 million, which is down 76% year on year and 64% versus the quarter, which is tough. And in terms of guidance, they're saying here, like this dividend right now it's $6.40. Some are speculating this is the last of the post-COVID kind of boom that's being factored in that in future quarters, they may cut their dividend. They may not offer any dividend at all. We'll see if that happens. Zim has been very transparent for a long time that they're going to pay 33% of their net income in dividends. I believe it was 33% or 40%. But again, so much is just going to depend on the shipping rates. So the rates have slid 38% quarter on quarter. That's not an annual drop. That's a quarterly drop. That's an insane drop. So the question is, have we hit bottom? Is this the lowest low for shipping rates? I can't answer that. No one really can. I know during their earnings call and in the past they've made comments to that effect, like, oh, we think it's bottoming, or in the earnings call, I think they said, we think it's bottoming soon, but what does that mean? And again, you could see them compared to their competitors here. It's been tough, but that's going to be a real critical point. And also, here's something we were just touching on. So Zim has 50% of its trans-Pacific capacity on annual contracts, with 50% on spot. The mix is 25% contract and 75% spot in Zim's other trades. So Zim is much more than a lot of the other shipping companies dependent on the spot rates, which are critical and which have been absolutely devastated. So we'll see if these rates could increase. It looks like they have been stabilizing somewhat over the past weeks. But that, of course, is going to be a major factor Again, this is what I was saying. Their dividend policy is to pay 30% of net income in the first 3 quarters, then a fourth quarter payout. That'll bring it to between 30 and 55 and 50%. I think it was something like 44%. Could be wrong. But that's basically all I want to talk about for now. I think Zim is taking the steps in terms of focusing on their LNG and their ESG rating, focusing on paying out these dividends, and also focusing on expanding into and diversifying into other product lines, like I was showing you with their e-commerce, etc. So, I mean, we'll see if they're able to recover in 2023, or if 2023 is another tough year like 2022. But I think they're taking the steps at least, and they have that giant cash reserve to be well positioned to kind of ride out the storm. That's my opinion. But let me know yours. Let me know in the comments section what you think about Zim, if you've been buying Zim, if you were able to get it in that December-January dip, if you're selling, if you're going to hold your shares, and whatever your thoughts are. Look forward to hearing from you, and I'll catch you in the next one.